Hello my dear investors, the earnings season started. The quarterly reports move the stock price and provide insight into the current development of our favorite stocks. In this video I present you 3 quality stocks which published new numbers just a few days ago, and I reveal to you my personal favorite. My name is Thorsten, I'm the founder of Dividend Stocks Cash. It's all about long-term investing here to profit from nice capital gains and growing dividends as well. So let's go. The stock number 1 is PepsiCo. Of course, everybody knows what they do. And it's interesting because the stock price got a little hit, although the numbers were really good. It was impressive because this stock is not cyclical in nature. We have a reluctant, or we have a weakening consumer demand right now. We have a pending recession, but the organic revenue growth should be around 10% for the current business year. Adjusted earnings should grow even by 13% without exchange rate fluctuation. And with that, the estimates from the management were even raised up. So the business is doing fine. But Walmart's management said that they observed that people taking the medicaments against obesity from Novo Nordisk, like Wegovy or Ozempic, that they are buying less food, that they are eating less carbohydrates because they lose appetite by taking these medicaments. And this was the result or the reason for a little sell-off from the stock. So Pepsi's stock price was already close to $200, currently $160. Although numbers were good, as I said. And in turn, the dividend increased to 3% right now. Just some months ago, it was as low as 2.5% or even lower. And the 3% are above the long-term average. 5-year average dividend yield of PepsiCo is 2.75%. Currently, we are at 3%. And if you look, we make a little quality check, then we see nicely growing adjusted earnings here. Reported earnings are doing fine as well. Of course, we also have growing dividends. Growing dividends since 51 years already. So I have a dividend aristocrat with annual dividend growth between 6 and 8.5% each year growth, and a really rock solid business model. So I'm not afraid that here in the segments that PepsiCo sells beverages but also snacks, and snacks are in this segment Frito-Lay, and Frito-Lay does 27% of complete total revenue. And I'm not afraid that people don't buy it that much anymore because of some medicaments against obesity. Dividends are always nicely covered by earnings, but you need to be a little bit careful because by free cash flow, they are sometimes closely covered right now, very closely covered, and in 22 they were even not completely covered. This is because Pepsi makes huge investments in the last years. You can see it by adding the operating cash flow, and then you see that while operating cash flow sometimes even increases slightly, like here in 2019, free cash flow decreases, and the difference between the two are the investments. But even if dividends are not always fully covered, the balance sheet is really strong. I can show it to you. We have $10.3 billion cash. Pepsi has this, not me, unfortunately. And they pay dividends of $6.5 billion, which means they have enough cash to to pay around 5 to 6 quarters long dividends. So that's much, or this is really enough to cover a little bit like it was the case here. If free cash flow doesn't completely cover dividends, they can also stop making stock repurchases before cutting dividends. So dividends, in my point of view, are sure. Then we have the fair value calculation, because the stock price of PepsiCo dropped considerably from close to 200 to 160. We could assume that the stock is nicely valued right now. And let's check by taking the fair value based on adjusted earnings, and then we can see actually that the stock is slightly undervalued. Fair value about 164 to 165 US dollar, depending on which fair value you take for the last 4 quarters or for the current estimated business year, whereas which includes one estimated quarter. And if you look at the annual yield to expect till end of 26, we are at 10.2% annual yield, which is already attractive, about 1/3 dividends and the rest capital gains. You can expect, or in the long run, we had an annual yield for PepsiCo of 8%, close to 8%, and now when we buy it, we even have a higher expected annual yield than in the long-term average, because the stock is slightly undervalued. So PepsiCo could be an attractive buy. Let's have a look at the second stock, and the second stock is not that well known. It's called Infosys. Infosys is from India, and they are it's an IT consultant company, the second largest IT consultant company in India, and you can see it's a high quality stock. Let's check this by looking at the reported earnings and the adjusted earnings as well, and then we have also growing dividends, some special dividends also, and there's much more dynamic than, or dividend growth is much more dynamic, earnings growth of course too, than PepsiCo. But the annual yield, the dividend yield is close to PepsiCo, with also close to 3%. We can see it here. Here it's 2.95% right now, which is also really above the long-term average. The average yield within the last 5 years was 2.4%, so 0.5% more than the long-term average. Just a short time ago, dividend yield was as low as 1.5%. This was when the stock price went up, because Infosys profited from COVID, and you can also see it here visually that in 22, here 21, that the earnings went up a little bit more sharply than before. Here you can see it also very good. We're looking at the revenues. This is because COVID boosted digitalization, and many companies needed to prepare for home office and needed to pep up their IT infrastructure. And so it was good business for companies like Infosys. And even now, in general, I'm optimistic about this stock, because IT is so complex that normal companies need to focus on their core business model instead of becoming IT companies. And so there's enough to do for Infosys to help these companies, giving them consulting till outsourcing even the complete IT stuff. Anyway, Infosys faced now the same problem as, for example, Amazon does. It means they profited from COVID. They were growing very fast. They invested heavily, and now the growth goes back again a little, and they need to consolidate. Infosys, for example, does not hire new graduates from university anymore right now. Last year, they still employed 50,000 new people. And now they, as far as I know, they make no layoff, but they stopped hiring in big numbers right now. So this special turbo time from COVID is already over. Management also reduced the revenue forecast for the current business year, which ends end of March. Originally, they were thinking that revenues grow between 4 to 7%. Now it should be only 1 to 2.5%. So it re-estimate really came down. But in my point of view, this is a temporary problem. And if you look at the valuation, you see that the stock price came down as well from close to 2,000 rupee to currently 1,450 rupee. And if you look here at the earnings, we can take the adjusted earnings again to create the fair value. And here we see that we have massive overvaluation here till somewhere like this. And now the stock price came down exactly to the fair value, but now it already recovered a little bit. So it means that the stock price is still overvalued. Fair value close to 1,270 rupee and the current stock price 1,450 rupee. The annual expected yield now is 8%, which is already a little bit above the average expectation from the stock market, but it should be considerably less than if you invested within the last 20 years. There, your real annual rate was 40.3% compared to 8% right now. So 8% doesn't seem to be that attractive to me, and I would rather consider the stock a buy at fair value, where it was already this year and the first half of this year, at least 2 times. And a fair value about 1,260, and then we have an expected yield of about 14% because the growth is still around the same growth it was in the past. So for me, I would say a buy limit, let's say 1,250 rupee. I already did it exactly here. And you just enter the number. You can say 1,260 rupee, for example. You could also calculate it in euro or US dollar or whatever currency you want. But I mostly take the original currency here because then I don't care about the currency fluctuation because exchange rates can change from time to time. So at 1,260, and I will get an email when the stock price drops and my buy limit is reached. So now we have one more stock to go, and this stock is a US stock again, and this is Fastenal. Fastenal is also dividend aristocrat like PepsiCo, and the dividend yield is 2.3%, so it's the lowest of the 3, but the dividend increase is double digit. It is between PepsiCo and Fastenal with annual growth rates of dividends of about 13%. Fastenal is a little bit cyclical, but does very well in the current downturn. You can see it here that it is cyclical a little bit here when the earnings went down during the financial crisis. Now we have a little bit slowing because, for example, the fasteners are not going so well. What are they doing? They are in the construction business. They give you everything. Other companies need to assemble something and produce something. You can see it in the segment section, what they are selling here. And it's Infosys. Sorry, so I said it's a little bit, should be a little bit cyclical in nature. Yeah, here we see it better. So Infosys was slightly cyclical in nature. Fastenal is a little bit more cyclical in nature. You can see it here from 2.8 to 2.9, decreasing earnings, for example. And now also a slight consolidation of earnings. But in the long run, it really goes up nicely. And what they are selling, we can see it here. Here, the fasteners, for example, not going very well right now, but other segments do better. Anyway, the last reported quarterly earnings were very good and above expectations from analysts. And so the stock price really recovered and it's already close to the all-time high here. All-time high was about 65 US dollar. And now we have about 60 US dollar. Short time before the stock was as low as 44 US dollar. And if you just look at the quality check, I think you see that this stock is really high quality stock. Without going too much into details, let's have a check at the dividends. And here you can see that the 2.3% dividends yield is even slightly below the 5-year annual average of the dividend yield, which is 2.5%. If you look at the fair value and calculate it, we take the reported earnings here, the fair value based on reported earnings, then we can see that its stock price nicely respects the fair value. We had, same as PepsiCo and Infosys, here an overvaluation of the stock. You can also see it, by the way, by looking at the multiples. Then you also see that here around 2020, for our stocks from 2019 onwards, till recently the stock was really heavily overvalued. Let's check it here for, you see the same is for Infosys and the same holds true for PepsiCo. So let's go back to Fastenal, make the fair value calculation and let's see what annual yield to expect if you buy the stock right now. Maybe before, what annual yield did we get if we invested in the stock? 40.2%, which is basically the same as Infosys. So it's really good, high quality stock and made investors happy in the long run. Does it make us happy if you buy the stock right now? Let's find out. Price earnings is this, and current stock price is 60 US dollars, but fair value is just between 53 and 54, depending which fair value we take. And it means that the expected yield would be just 6.4% if you were buying for this price right now. And in my point of view, better looking or buying the stock at the fair value, which would be here around 53 US dollar. And then we have at least expected yield of 10.4%, which is still less than in the past, which there might be a reason that the expected growth rates are not that high as they have been in the past. Let's find out. In the past, we had even some double-digit growth rates, and then in between some mid to high single-digit growth rates. And now here in the for the next business year, we have no double-digit growth rates, but just medium to high single-digit growth rates, and this is why the expected yield is lower. It's only 2.4%. Maybe the stock price will come down or even a little bit more. If you want the annual historic rate, then you should buy the stock for maybe 49 US dollar, something like this, or even 47 US dollar here. And then you have your yield you got in the past. The stock was already low as 44 and even below 44 US dollar 1 year ago. So I would place here, you see it already, a buy limit. I entered 48 US dollar. You can choose whatever you want. You could even go lower. So these are 3 stocks. I also promised you to present you my favorite. And my favorite right now is the slowest growing stock. It's PepsiCo, because PepsiCo is a very solid business model, the least risk, and I think it is undervalued right now because this sell-off due to obesity medicaments is exaggerated in my point of view. It could be a nice possibility now to get this stock. So if you don't need dynamic dividend growth, but a really solid dividend growth, solid high quality stocks, then maybe PepsiCo is the way to go. So what do you think, which is your favorite of these three? Do you have an own favorite you want me to analyze later? Just drop a comment below and I would be happy to discuss. Thanks for watching and see you next time. Bye bye.